I'm Allison LaForgia, the managing editor of HousingWire's content studio, and I'm with HousingWire's lead analyst, Logan Mohtashami. Logan, thank you for sitting with me today.
It is wonderful to be here.
So I'm gonna ask you a bunch of really Mortgage 101 questions today. So for people who are new to the HousingWire audience or new to the mortgage and real estate industry, we're gonna get the mortgage rates man himself to answer all of the basic questions. Are you ready to jump in?
Absolutely, 100%.
So let's start with the first question, which is, what should we expect in the back half of the 2025 housing market?
So obviously, there's some really good news about the housing market that's not being told about, and one of them is that purchase application data for the first time in many years is actually positive, year over year for 18 straight weeks, where last year that wasn't the case. So because sale levels are at historic low levels, everything in July to November, the reports that we get from June to October, even if home sales just stay flat, we're gonna have year over year growth. So the fact that even with elevated rates, elevated property taxes, prices, everything, people are applying for mortgages, that is a positive sign to say, usually we don't see that until mortgage rates get towards 6%, but this year has been different. New home sales purchase application data just hit a post-COVID high. They just had one of the highest sales prints in years. So there's a little bit of better backdrop to show some growth on a year-over-year basis going out for the rest of the year.
So let's talk a little bit, going back a couple steps, about mortgage rates. How are mortgage rates determined and who sets them?
So I always say that there's a lovely couple in the economic world. It's the 10-year yield and 30-year mortgage rates. They've been slow dancing really since 1971, and really if I wanted to take this back 100 years. What goes into the mortgage rates, I believe, is 65 to 75% of where the 10-year yield can range is really Fed policy. And then the 10-year yield and 30-year mortgage rates tend to move together. Then there's the mortgage spread, the difference between the 10-year yield and the 30-year mortgage. We like intimate slow dancing, very close. 1.6 to 1.8% is the historical norms. But lately in 2023, it got very high. This does happen in economic cycles. We had over 3% spreads. So spreads are coming in lower. That means mortgage rates are acting better. Again, if the economic data gets weaker and the bond market thinks that the Fed's going to cut rates more, 10-year yield goes lower, mortgage rates tend to go lower with it. So it's really long-term debt borrowing, 10-year yield, 30-year fixed, Fed policy, mortgage spreads, all put together. That's how mortgage rates have worked since 1971.
So that's the secret sauce that we're talking about going into all of our daily mortgage rate update videos.
Absolutely. We see how the economic reports are taken by the bond market. Where the bond market goes, the 10-year yield follows in terms of yields, and then mortgage rates typically go in that same direction. And then we work off how the spreads are acting on the day.
So let's talk specifically about what economic reports you look at that we mention in the tracker and in the HousingWire Daily podcast that Logan's now on 3 days a week?
Yes, 3 days a week. We're going to get it to 4 eventually. Yes, for me, it's always been more about the labor market than inflation. The growth rate of inflation has fallen on a year-over-year basis from the highs of COVID, but the labor market is still firm enough to where the Fed policy is still elevated. So jobs Friday that comes in, the job openings data that comes in every single month, jobless claims is a data line, very key to economic cycles. That happens every Thursday morning, 5:30 a.m. Pacific. And the ADP report is also, those are the labor data that actually move the markets. Then there's the CPI and PCE inflation reports that happen once a month. Those are other data line sets that come into play with rates. Retail sales, car sales, these things are things that we track to go with economic cycles, right? Economic cycles, each cycle is different, but the economics behind it typically aren't. So we always keep an eye on the labor data, because what traditionally happens is when a recession happens, bond yields go down, rates go down with it, and then historically housing demand picks up.
So this has been a topic that you and Sarah have revisited in all of recent episodes of HousingWire Daily, but also comes up cyclically, in that you guys talk about HousingWire tracks purchase applications. So talk about that specifically and how there's different people who track different things, just so our audience understands what we're talking about.
So mortgage demand is the big driver of housing demand. If you look at purchase application data going back to the 1990s, it typically leads sales about 30 to 90 days. So when purchase application data volume rises, usually existing home sales volume rises. This is why we track it, but we track it on a weekly basis and then tell everybody this means 30 to 90 days out. If it's growing on a year-over-year basis, it's a positive. And then our weekly tracker, we also have our weekly pending home sales data that gives us an idea of homes that are going into contract. And we also have our total pending sales data. We incorporate them all together to see how demand is going as of today, instead of waiting 2 to 3 months to get it from the existing home sales report.
And how is that different than how other people look at it?
Other people use old traditional media models where you actually have to wait 30 to 60 days to get the report itself. We look weekly, fresh, and forward, which is much different. If you're waiting for the existing home sales report, you're about 3 months behind our data line. And that's just how traditional monthly reports go. We believe on following fresh weekly data to tell us what's happening at the end of the week and then what's going to look like going out in the future. That's much different than waiting for stale data, as we call it.
Well, Logan, thank you for taking us through Mortgage Rates 101. If you have any questions, drop them in the comments below on YouTube, and we'll try and make another video soon.